All right, let's talk about something that's practically an open invitation for an IRS audit. Imagine this. You've got a farm, you're sinking real money into it, but right now, it's making absolutely nothing. Zero income. This isn't just a tricky financial spot to be in, it's a high-stakes tax gauntlet. One wrong move on your return, and you could face some really serious consequences.
So, here's how we're going to tackle this. Think of it as a roadmap for getting through that gauntlet. We're going to walk through the hurdles the IRS throws at you one by one. And believe me, each one is a major test, from just proving your business is, actually a business, all the way to defending your core intention to ever make a profit. Okay, let's dive in.
First up, let's really set the stage here. The whole dilemma starts with a pretty simple fact pattern, right? You've got farmland, you're putting money in, but there's no income coming out, at least not yet. And right away, that forces a really big question. In the eyes of the IRS, what are you? A farmer or an investor?
So the big question is, can you deduct all those expenses? You go and file a Schedule F. That's the form for profit or loss from farming when you have zero income. Well, that's a pretty bold move. You're basically planting a flag and telling the IRS, hey, I'm running a legitimate business here under Internal Revenue Code Section 162. And you better believe that's going to get their attention.
And this is where the core conflict really comes into play. See, if you're an active farmer under Section 162, those losses you're racking up can create something called a net operating loss, or an NOL. That's a huge deal. It's a powerful tool that lets you take those farm losses and use them to lower your taxes on other income. But the IRS might come back and say, nope, you're not a farmer, you're a passive investor under Section 212. And if they win that argument, poof, that immediate tax break is gone, your losses get suspended, basically put on ice, and you can't touch them until the farm starts making money or you sell the land. Okay, let's tackle that first hurdle, the difference between just starting up and actually running a business. You see, before you can even get into a fight about whether you're trying to make a profit, you have to prove your business is even off the ground. And when it comes to the IRS, timing is absolutely everything. So, according to Section 162, you can only start deducting your day-to-day expenses once you are actively carrying on your trade or business. Now, what does that actually mean for a farm? Well, it's not about your first sale. It's not when you sell your first tomato. It's when the real operational work begins, when you're actually tilling the soil, you're planting the seeds, you're bringing in the livestock. That's the moment the IRS considers your business a going concern.
Now, on the flip side, you've got Section 195. This covers all the costs you rack up before that starting gun goes off. We're talking about things like getting your soil samples analyzed, clearing brush off the land, even the travel you did to investigate if buying the farm was a good idea in the first place. The IRS is crystal clear on this. These are startup expenditures, and they are not the same as your regular deductible operating expenses. And here's the rulebook for how you have to treat those startup costs. You can't just write them all off right away. No. In the year your business officially kicks off, you can choose to deduct up to $5,000. But anything over that, you have to amortize it. Basically, spread the deduction out over 180 months. That's 15 years. And here's the trap. If you mess this up and try to deduct all those startup costs on Schedule F before the business has actually begun, the IRS can just say nope and disallow the whole thing. And the worst part, you could lose that tax benefit forever.
All right, so you made it past hurdle number 1. Your business is officially up and running. But don't get too comfortable, because the next challenge is right around the corner, especially if you're growing anything that takes a while. I'm talking about the Uniform Capitalization Rules. You'll hear them called UNICAP, and they fall under IRC Section 263A.
2 years. That's the number you have to remember. Under Section 263A, if you're producing plants that take more than 2 years to become productive, you generally have to capitalize the costs. Now, what does that mean? It means you can't just deduct the expenses each year. Instead, you have to add them to the value or the basis of the plants themselves. We're talking about things like vineyards, apple orchards, Christmas tree farms, anything with a long lead time.
This brings us to a huge strategic decision. The good news is you can actually choose to elect out of these UNICAP rules. If you do that, you get to deduct all those pre-production costs right now on your Schedule F, which can create a nice big loss to offset other income. But, and this is a really big but, it comes at a price. If you make that choice, you're then forced to use something called the Alternative Depreciation System, or ADS, for all of your farm property. That means your equipment, your barns, your fences, everything gets depreciated much, much more slowly. It's a classic case of short-term gain for long-term pain.
And now, we've reached what you might call the final boss of this whole gauntlet. You've got no income, you've got a pile of expenses, and that means you are automatically staring down the biggest challenge of all,
proving to the IRS that your farm is a real business and not just a very expensive hobby. This is the battleground of Section 183, the hobby loss rules. You know, the tax code tries to be helpful sometimes. It offers this thing called a safe harbor under Section 183D. Basically, it says if you can show a profit in 3 out of any 5 years, the IRS will just presume you're trying to make a profit. Sounds great, right? Well, for a zero-income farm, it's completely useless. You can't possibly meet that test. So right out of the gate, that presumption is gone, and the entire burden of proof lands squarely on your shoulders. So with that safe harbor out the window, you're left with this. And this comes straight from the Treasury regulations. You have to prove you had an actual and honest objective of making a profit. Now listen to that language carefully. It's interesting. It doesn't say you needed a reasonable expectation of making a profit, just an honest objective. But you can't just say it, you have to back it up with cold, hard, objective facts.
Okay, so how in the world do you prove that? How do you build your defense? Well, your entire case is going to come down to how well you can satisfy a checklist of 9 specific factors that the IRS lays out in its own regulations. And here they are. This is the 9-factor test the IRS is going to use to get inside your head and figure out your real intentions. As you can see, they look at everything, the way you run the operation, your own expertise, even how much fun you're having. And while an auditor will look at all of them, for a farm with no income, there are a few on this list that are absolutely critical. Let's start with number 1, because it's probably the most important. You have to operate in a business-like manner. This is completely non-negotiable. What does that mean? It means a separate bank account for the farm. It means keeping detailed, meticulous books. And, maybe most importantly, it means having a formal written business plan that shows how you're eventually going to get to profitability. If you're mixing your personal grocery money with your farm account, that's one of the biggest red flags you can wave at an auditor.
Now, factor number 4 can be a real game changer. This is the expectation that the farm assets themselves, primarily the land, will go up in value. This brings in something called the Unitary activity rule. It's your chance to argue, look, my profit motive isn't just about selling hay. It's a combined strategy of farming and holding this appreciating land. But, and you knew there was a catch, it only works if your farming activities are actually reducing your costs of holding the land. It can't just be a flimsy excuse to write off expenses on a property you're just waiting to sell.
All right, so let's talk about what happens if you lose this fight. What are the consequences if the IRS says, we've looked at the 9 factors and we've decided this isn't a business, it's a hobby? Well, I'm not going to sugarcoat it. The outcome is pretty brutal.
So it used to be that even if you had a hobby, you could deduct your expenses up to the amount of income the hobby brought in. But the Tax Cuts and Jobs Act, the TCJA, back in 2017, it completely changed the game. It hit the pause button on the entire category of miscellaneous itemized deductions, which is exactly where hobby expenses lived. And this created a really nasty result that tax pros call the Gregory Trap.
So what is the Gregory Trap? It's simple, and it's devastating. If your zero-income farm gets reclassified as a hobby, the amount of expenses you can deduct is exactly this: 0. Nothing. Every single penny you spent on feed, seed, fuel, repairs, it's all gone. Through at least 2025, you get to deduct a big, fat 0.
And just to make things more fun, even if you navigate the hobby loss rules perfectly and prove your profit motive, the gauntlet still isn't over. You still have to contend with a whole other set of potential limitations. Things like the at-risk rules in Section 465, the passive activity loss rules in Section 469, and the excess business loss limitation in Section 461. Any one of these could still come along and limit the losses you can actually deduct.
So, when you boil it all down, what's the key takeaway here? Getting through this tax gauntlet has less to do with how good a farmer you are and everything to do with how good your records are. It's about having a compelling story backed up by bulletproof documentation. You have to prove you're running a business even when it's not making a dime. So I'll leave you with this question. If an IRS auditor sat down at your kitchen table right now and asked to see your records, what story would they tell? Would they tell the story of a business, or would they tell the story of a very, very expensive hobby?